There is a new loan program that will allow you to buy a home with just 1% down. Yes, you heard me correct, just 1% down. And it's a better loan than FHA in many ways. And in today's video, we're going to dive into this loan program in detail. We're going to go over the loan qualifications. In fact, there's two different programs that allow this 1% down. We're going to go over both of them. One of them is going to offer considerably better terms, in my opinion, than the other. But either way, I think it's worth going over both because there are some pros and cons to each. So the two loan programs we're going to be talking about today is the UWM 1% down conventional loan, as well as the Rocket Mortgage Rocket One Plus loan. Now, both of these loans are going to follow the HomeReady and Home Possible guidelines. Now, if you're listening to this going, Jeb, what does that actually mean? Well, let's take a minute here and talk about it. One of the main guidelines is that your total qualifying income cannot be more than 80% of the area median income. Now, if you're watching this going, what is the area median income? Well, I actually put a link in the description below that you can go check out. You can go type in your city. It will not only tell you what the 100% area median income is, it will also tell you exactly what the 80% median income is. So in total, your qualifying income between everybody on that loan cannot exceed that amount. So if you have one borrower on the loan, that means their income cannot exceed 80% of the area median income. If you have two people on the loan, their combined incomes cannot exceed 80% of the area median income. Now, another thing with HomeReady and Home Possible loans, they require a 3% down payment. If you've ever heard of a conventional 3% down, then they were talking about HomeReady and Home Possible loans. Well, these two mortgage programs follow those guidelines. So meaning you need 3% down to purchase the home. But here's the thing, you only have to bring in 1% because the lender is actually going to cover the remaining 2%. Now, if you're watching this going, Jeb, what's the catch? How do I have to pay this back? Do I have to pay this back? Is this a loan of some sort? And the simple answer is no. It's more or less a grant from the lender to cover that 2% down payment with absolutely no strings attached other than some restrictions on how much they'll actually contribute, which we're going to talk about here in just a minute. Another thing about both of these loan programs is you do not have to be a first-time home buyer, which is nice. You can own another home and still use this loan program to buy a new primary residence. Now, here's the thing. If both buyers are first-time home buyers, they are going to require home buyer education just to make sure you understand the program and exactly how it operates. Some other things to note is it has to be a 30-year fixed loan, which means that they don't allow any adjustable rate mortgages, only 30-year fixed. In addition to that, you have to have a minimum credit score of 620 in order to qualify for this program. On top of that, they don't allow any non-occupant co-borrowers. Now, if you're watching this going, Jeb, what does that mean? That means if your parents were willing to help you qualify for the loan, which you can do with conventional loans, which you can do with FHA loans, they essentially use their income to help you qualify. If they're not living in the property with you in this case, then you're not going to be able to use them in order to help you qualify. Now, with that said, I want to talk about the two programs specifically in more detail and also give you my opinion on which one is the better program. But before we do that, I want to take a minute here and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, I'm trying to hit 100,000 subscribers. So do me a favor and subscribe to the channel if you find any value in my content at all. Now, before we get into these two programs, something I want to be very specific on. I'm not a mortgage broker, right? I am a real estate agent. I used to be a mortgage broker for 10 plus years, so I still follow guidelines. So I'm here giving you unbiased information, just my opinion on looking at the two different programs. At the same time, you shouldn't take the information that I'm giving you in this video and try to determine whether or not you qualify for this program just based off the information I'm giving you. You need to have a conversation with a mortgage professional. Let them take a look at your income, let them run your credit, fill out the loan application, go through the entire process just to make sure you're getting accurate information and so you can determine whether or not you actually qualify for this loan. Now, if you're watching this video and you don't have a trusted resource, well, I've already done the legwork for you. If you need a mortgage broker anywhere in the United States, do me a favor and check the link below. I'm happy to refer you to somebody I know, like, and trust that can guide you through that process. Keep in mind, it's free. All they're going to do is ask you some simple questions, ask you to fill out some information, provide some documentation, and they can tell you exactly how much home you can afford. So if you're interested, do me a favor and check that link below. Now, the first of the two programs that I want to talk about today is the UWM 1% down conventional loan. Now, this is a loan program that would require you to use a mortgage broker in order to get the loan. They don't have a retail center. They don't have a bank that you can walk into. They don't have a phone number that you can call UWM and get a loan. You have to go with a mortgage broker that is approved with UWM in order to get this mortgage. That same link that I mentioned just a moment ago will get you in touch with somebody that is approved with UWM that can guide you through that process. Now, as I mentioned a moment ago, this is a 1% down mortgage, which means you come in with 1% down. So let's just say, for example, you're buying a $300,000 home. You come in with 1% down, which is $3,000, and UWM will contribute the additional 2%. But here's the catch. Only to a max of $4,000, which in this case would not cover your entire down payment, because 3% down on a $300,000 purchase is $9,000. So if you brought in $3,000, which is 1%, and they gave you $4,000, that's only $7,000, which means using this program, you would come up $2,000 short. Now, in addition to that, something to keep in mind is that you're likely going to have closing costs when buying a home. Even if you buy a home cash, you typically have closing costs, things like title, things like escrow, things like appraisal fees, credit reporting fees, transfer taxes, all of these different fees that are usually required when buying a home. So even in the case that you're buying a $200,000 home, for example, you come in with the $2,000 because that's 1%. And then they cover the additional $4,000. So that is all of your closing costs covered with this UWM program. There's a really good chance that you're going to have some additional costs when it comes to closing costs. But here's the nice thing. Both of the programs that we're going to talk about today allow seller credits. They also allow temporary buy downs. So if you're able to get a credit from the seller in order to cover your closing costs, then there is a really good opportunity to buy a house with just 1% down. But in which case the seller's not willing to contribute, you need the additional money for those closing costs, on top of any down payment that they might not be covering if your purchase price exceeds $200,000 in this case. Now here's the thing, with the UWM program, they will allow a loan amount up to $726,200. In addition to that, the monthly mortgage insurance is actually reduced when using this UWM program. Typically, they require a 35% coverage, but with UWM's program, they're only requiring a 25% coverage. And that's going to be one of the big differences in this program and the other program, as the other program we're going to talk about here in just a minute doesn't require any mortgage insurance at all. On top of all of that, this program is only going to be for single family homes, condos, and townhomes. You cannot use this program with units. Now, the second program we're going to talk about today is the Rocket One Plus. In my opinion, this is going to be the better of the two loans for a number of reasons, which we're going to talk about here in just a minute. So again, this program is a 1% down program. So in the example that you're buying a $300,000 home, again, you're coming in with $3,000. Rocket is covering the additional 2%. Now, something I didn't mention at the start of this is Rocket is a retail lender, which means that you can call them up directly and speak to one of the kids in the call center. I don't recommend doing that. I recommend working with a broker who is approved with Rocket. Just like we talked about earlier, UWM is just for brokers. Well, Rocket has a retail side and a broker side. With a broker, you typically get experience. You get someone that knows what they're doing. Now, a moment ago, I mentioned a kid in a call center. They hire people that have no idea what they're doing. And so oftentimes you can call Rocket, for example, and you might get pre-approved. Well, if their loan officer didn't do their job correctly, there's a good chance that you think you're pre-approved. You go out, put an offer on a home, you get accepted, you get under contract, and once the file is fully underwritten, they figure out you actually don't qualify because the person that was talking to you had no idea what they're doing. Now, that's not always going to be the case, but one thing I can tell you is that brokers are better. So I would highly recommend, if you're going to use a program like this, you need to talk to a broker. Now, if you're wondering where you can find one of those, as I mentioned earlier, if you need a free pre-approval, I've put a link in the description below. Now, one of the nice things about the Rocket Plus mortgage that differs from the UWM purchase is that they will cover a higher down payment than that of UWM. UWM, remember, the max that they would cover is $4,000. Well, the max that Rocket Plus will cover is $7,000. And that's because their max loan amount with this program is $350,000. So if you watched earlier, you knew in the video that UWM allowed you to go to $726,200. Well, Rocket's max purchase price is $350,000. So something really important to note here, areas like Southern California, areas like New York, you know, those really expensive areas where the median price of a home is above, say, $300,000, $400,000, $500,000. Well, those states are going to be really difficult in many cases to use this program because of the restrictions, not only on the area median income that we mentioned earlier in the video, but also on things like the loan amount. But another nice thing about the Rocket Plus mortgage is they will allow you to put more money down. If you have, say, 3% that you want to put down, you can put 3% down and they'll still give you the 2%. But that would actually be the max you can do with the Rocket Plus program, is that they don't allow you to have a total of more than 5% down. And that includes the 2% contribution that they would be giving you. Now, I didn't mention that earlier with the UWM program, is they don't actually have a max that you can put down. So if you're considering using the UWM program, you could put 10% down and they would still give you that $4,000 to go towards your down payment if that's something you want to consider. But here's the really nice thing about Rocket that UWM doesn't have, and that's that they pay for your mortgage insurance up front. So it's not that the loan doesn't have mortgage insurance, it's just the fact that Rocket is covering that mortgage insurance up front through the close, so you don't have any monthly mortgage insurance, which is absolutely huge because in many cases it can save you upwards of $100 per month. And just like we mentioned earlier in the video, there is a minimum credit score of 620, but also a max debt to income ratio of 50%, which means it's not going to be quite as lenient as, say, an FHA loan, but the terms are likely going to be way better because, one, you don't have any upfront mortgage insurance, two, you don't have any monthly mortgage insurance, but the income and the loan amount restrictions are quite a bit more restrictive, which means in many cases FHA might still offer you a better opportunity, especially if you're a high income earner or looking to purchase in an expensive state like California. So what I want to do here is recap these 1% down mortgages, more or less go over the benefits. So we talked about lower down payment. You're only having to come in with 1%. UWM is giving you the 2% down up to $4,000 with a max loan amount of $726,200. Whereas Rocket, again, you're coming in with 1% down. They're giving you 2% up to $7,000 because they have a max loan amount of $350,000. You essentially have lower rates with both of these programs than other programs out there, and that's because the LLPAs are essentially eliminated with these programs. What are LLPAs? They're the loan level price adjustments that we've been talking about over the last couple of months. There have been big changes in these loan level price adjustments that have made mortgages way more expensive. You've probably heard it circulating the internet, how lower credit scores are getting a better rate than higher credit scores. Well, that's actually what they were talking about, is loan level price adjustments. Well, with these loans, you don't have them, which essentially ends up giving you a better interest rate. On top of that, the mortgage insurance is either reduced, or in the case of Rocket Mortgage, it's eliminated because it's being paid by them. So you have no mortgage insurance when using the Rocket program. But here's the catch. Your mortgage payment is going to be higher than if you had a larger down payment. So this loan is not going to be for everyone. In fact, something you have to keep in mind is if you're only putting 1% down, the lender's contributing 2% down, you only have 3% equity in that property. So very, very little equity in that property. That means if home prices stabilize, if they move down at all, there's a really good chance that you could be underwater on that mortgage, especially if you're trying to sell that home, because selling costs can range anywhere between 5, 6, 7% in many states out there. So if you're considering buying a home, just make sure you have a longer term time horizon, something we talk about all the time. Whether you're putting 3% down or 5 or 10 or 20% down, you need 5, 7, 10 years on your side. And not because I believe the housing market's going to crash, but because real estate doesn't necessarily appreciate 15, 20% a year like we've seen over the last couple of years. That's not normal. What is more normal is homes appreciating 3 to 5% a year over time, which means you need time on your side. So just understand when you're putting less money down, there are definitely some risk out there, but it's not a reason not to buy as long as you understand them. Now, if you're new to the process of buying a home, you're not sure where to start, I created a first-time home buyer course to guide you through that process from A to Z to make you an expert in buying a home. So if you're interested in becoming an expert, do me a favor and check the link below. And the last thing to keep in mind with this program is that you might have a little bit more of a difficult time qualifying if you don't have higher credit scores. Yes, they allow credit scores as low as a 620, but if you have a 620, for example, you're likely going to find it a little bit more difficult to get your loan approved. So if I were a buyer out there and I had lower credit scores, I would focus on improving those scores. The higher your credit score is going to result in a better interest rate, and a better interest rate is going to essentially result in a lower monthly payment and also allow you to qualify for more home. And the last thing I want to say is make sure you're working with an expert, whether you're getting qualified for one of these loans, an FHA loan, a conventional loan, it doesn't matter. Make sure you're working with someone that understands what they're talking about, can guide you through the process, can answer your questions, and explain things in detail. If you don't have that person, again, there's a link in the description below. The last thing I want to do in today's video is essentially give you an example of how one of these loan programs works, what it looks like. Well, I looked up properties in Los Angeles. I'm here in Southern California in Orange County. And unfortunately, we don't really have any properties under $350,000, but I was able to find 2 condos in LA County priced at $295,000. So the first thing we need to do to figure out whether or not you would qualify is figure out the area median income. Well, the area median income in LA is $117,480. But here's the catch. Again, we have to be under 80% of the area median income, which in that case is $97,900. So if we made less than $97,900 combined, essentially we would have the income qualifications to be able to qualify for this mortgage. Now, if we made $97,900, that means our monthly income would essentially be $8,158 per month. And we know, based on the guidelines that I mentioned earlier, you can't have a debt to income ratio more than 50%, which means if you had absolutely no debt at all, your mortgage payment could not exceed $4,079. So in the case of running the mortgage payment on this particular property, we'd be looking at a total mortgage payment of $3,128. That includes the $887 HOA that's associated with this property. So anybody out there telling you that there's no properties in Southern California that would qualify, well, I just showed you one. But honestly, it's going to be easier in areas that don't have high prices like Southern California. Now, if you're watching this video going, Jeb, I want to buy a house, the 1% option doesn't really sound like it's for me because I don't meet the income guidelines and maybe I don't meet the credit guidelines or whatever, but you're still interested in buying a house, well, do me a favor and check out this video here where I explain FHA in more detail.